The stock market just exploded, and we're not talking small gains. We're talking 2.2 trillion in market value added in just a matter of days. But here's the million-dollar question. Where did all this money come from? Was it just investor, hype, institutional manipulation, or something deeper? In this video, we'll break it all down, from the triggers behind the market boom to who really cashed in, and what this means for you as an investor. Buckle up, because this isn't just a finance update, this is financial fireworks. The explosion, what just happened? The financial world just witnessed a massive surge. The US stock market saw a sudden injection of $2.2 trillion in value, a spike that had Wall Street cheering, retail investors scrambling, and analysts desperately trying to keep up. But how did this happen? It wasn't a single stock or one industry. It was a wave sweeping across tech, energy, consumer goods, and even struggling sectors like real estate. Major indices like the S&P 500 and NASDAQ jumped significantly. Big tech companies saw billions added to their market caps almost overnight. What triggered it all? Surprisingly, it wasn't some miracle product or unexpected profit surge. It was data, the trigger, one report to rule them all. The catalyst behind the boom? A much-anticipated inflation report, the consumer price. Index CPI data showed inflation cooling faster than expected. That single report turned the tides. Wall Street, which had been holding its breath, suddenly exhaled in the form of wild optimism. Why? Because lower inflation means the Federal Reserve might pause interest rate hikes, or even cut rates in the near future. Interest rates are like oxygen for the markets. When they're low, borrowing becomes cheaper, business investment picks up, and stock valuations soar. So with just one hint of relief from the Fed, investors rushed in like it was Black Friday on Wall Street. The real MVPs, who made the most money? So who made bank during this explosion? Big tech was the biggest winner. Companies like Apple, Microsoft, Amazon, and Nvidia added hundreds of billions to their market caps. AI-related stocks were on fire. Investors are betting that cheaper borrowing costs and rising demand for AI will fuel record-breaking profits in the coming quarters. Retail investors also saw their portfolios grow, especially those who held on to tech-heavy ETFs or index funds. Meme stocks even tried to make a mini comeback, riding the wave of optimism. And then there were the institutional whales, hedge funds, investment banks, and sovereign wealth funds who jumped in early and bought the dip during the correction. These guys didn't just make money, they printed it. Wait, where did the $2.2 trillion actually come from? Now here's the mind-bending part. People often ask, where does this money even come from? Did someone just wire $2 trillion into the market? Not exactly. That money comes from market capitalization increases, which means investors are willing to pay more for shares than they did before. Stock prices rise based on future expectations. It's psychology meets economics. If investors believe companies will perform better in the future, especially with lower interest rates, AI breakthroughs, or improving global conditions, they're willing to pay more today. The moment enough people start buying in, boom, trillions in value are added across the board. It's not like a government printed $2.2 trillion. It's the perception of future profitability that shifted, which boosted prices, which raised total market value. Is this growth real or just a bubble? Great question. And here's where things get spicy. Many analysts are already warning, this could be another bubble forming. When markets move this fast on emotion and speculation, without real earnings or production increases to back it up, there's a risk of a harsh correction. Think back to the dot-com bubble, or even the 2021 meme stock mania. Sudden spikes are often followed by equally dramatic crashes. But here's the counter-argument. This time might be different. Unlike past bubbles driven purely by hype, today's market growth has solid pillars: AI innovation, infrastructure investments, and a maturing digital economy. Still, cautious optimism is the name of the game. What does this mean for you? If you're an investor, whether seasoned or just starting out, this moment is a reminder of how fast things can change in the markets. Should you go all in on tech stocks? Not necessarily. But should you understand the trends, watch inflation, monitor the Fed, and diversify wisely? Absolutely. This market explosion has created opportunities, but also increased risks. Make sure you're not chasing the highs blindly. Use tools, do your homework, and don't get swayed by FOMO. Smart investors look for value, not just hype. And right now, with earnings season around the corner and global uncertainty still in the mix, every move you make should be calculated, not emotional. $2.2 trillion. One report. A wave of investor euphoria. The stock market just reminded us that perception is powerful, and timing is everything. Whether this is the beginning of a long bull run or just another sugar high, only time will tell. But if there's one lesson here, it's this. Earn. Smart, not fast. Stay informed, stay focused, and stay grounded in strategy over hype. Thanks for watching. And if you want more breakdowns like this, from financial booms to market meltdowns, make sure to keep it locked right here. Until, next time, invest smart, live smarter.